Hello bankers, welcome to learning sessions. I'm Himanshi Malik and today we are going to discuss chapter 25 in module C. So chapter 25 is going to be about capital investment decisions and term loans. So we have studied in the first chapter of module C, that is chapter 19, that a financial manager, a finance manager has to take many decisions, and one of those important decisions was investment decisions. So in this chapter, we are basically going to understand the aspect of a manager when he is taking an investment decision. What are the different aspects, what are the different angles you need to analyze before making any investment? So, we will discuss it in detail. And if you want to study each chapter of your JIIB in detail, you must enroll in this course because we are going to cover everything in JIIB in the early bird pack, which is valid till exam. So do enroll in the course and prepare for your exams in a better manner. And to enroll in the course, you can download our app, Learning Sessions IIBF Exam app, which is available both on Android and iOS. By downloading this app, you will get access to all the courses available and much more. Informational videos will be provided to you. So do enroll and download the app, and let's get started with our course and chapter 25C. So the chapter is capital investment and term loans. So what do we mean by investment appraisal? We know that whenever we have to do a business, we need money, and that money can either come from capital or debt. That is the basic concept we covered. And capital can either be your own or you can ask the investors, right? So that is one thing. And another thing is, now we know these investors, they are investing in our company. Now we have to step into the shoes of these investors. Or in other words, if I say that if I'm running a business, I need to analyze, okay, I have three options. One is to expand into a newly market. Second is to discover a new product, or introduce a new product in my product range. Or option 3 is cutting the cost of my existing production of a particular product. So invest in the machinery. So we have to analyze each and every option and see which one is giving us the best result. What do we mean when we say best result? It means that the investment or the initial outflow of cash, initial cash outlay is minimum and the return is maximum. So this is what we analyze in the investment decision. So that is what they're saying. Techniques used by firm or an investor primarily to determine whether an investment is profit making or not. So we will understand what are the different method of appraising an investment. And here we have discounted model and non-discounted model. Now, what do we mean by these models? I give you a brief introduction on a topic called time value of money. What was the time value of money? That the amount that we're going to receive in future, if I say I'm going to receive 1100 in the future, will not have the same value today, right? This 1100 after a year has low value today. If I say the interest rate is 10% in the market, so today its value will be only 1000, and that's how the time value of money works. So when we have to make an investment decision, the cash flow are going to be received in the future. So we cannot take those cash flow for their face value because their actual value today will be lower, right? So in order to calculate actual profit, we need to discount these future cash flow, which is called discounted method. For example, let's say this case, it is asking me to invest 800 initially and I will get 1100 in the future. So if I just say see the raw terms, the return I'm getting is 1100, investment is 800, and the profit is 300. Now according to finance principle, this is completely incorrect because this 800 we are taking at 0 point of time, and this 1100 is going to be received after a year. So the time difference is there, due to which we cannot say that this 300 profit is accurate. What we need to do, we need to bring both the amounts in one place of time, that is today, when we are going to make the investment. And if this 1100 today has a value of 1000, then the investment 800 means 200 profit I'm getting, and this is a profit we need to consider because both the values are at 0 point in time. So that is how we calculate the investment profit on discounted method. We will study the methods in detail, but this was just to give you a brief on the calculations. Another one is non-discounted method, in which we do not discount the cash flows, but we take other approaches to calculate if the investment is profitable or not. We will see through different models in each of these in detail. So what happens in discounted cash flow method? The cash flow is discounted through a discounting factor. The discounted cash inflows and outflows are then compared. It takes into account what? Time value of money. So in discounted method, we have two further approaches. First one is net present value, which is also called NPV, and another one is internal rate of return, which is called IRR. Now, these two methods are of utmost importance for you in the finance world, and you should be completely familiar, completely comfortable with these terms and their calculation. Very easy to calculate, but also very important. So, the first one is net present value method. So what happens in the NPV method of calculating the investment profit? Let's understand. So we are continuing with the net present value method. Before I start this method, there are a few terms that I want you to be introduced with. So the first one is cash outflow. Second is cash inflow. Third one is your time period. And fourth is rate of return. And fifth is discounting factor. Okay, so we will discuss each of these terms in detail, but before that, one important principle that you need to remember in discounted method of calculating investment decisions. Okay, and that basic rule is, whenever we are evaluating investments, we need to ensure that our cash flow, cash outflow, and cash inflow pertain to same period. Now, what do we mean when I say this? I just gave you an example. I will take it one more time. So our example was, today I have to invest rupees 800, on which I will get return after 1 year of rupees 1100, and I need to evaluate my net profit from this investment. So to calculate the net profit, what I need to do, I will create a timeline. Okay, so this is 0, this is 1, 800 and 1100. Now I need to calculate what will be the value of this 1100 at 0 point in time. It means the future value, I have to bring it back to today. I have to calculate present value. When we calculate present value of any future value, it is called discounting. Okay, so how we calculate present value? So PV is equal to future value divided by 1 plus R over T. Okay, so this is a formula to calculate the future value. How does this formula work? So if I have 1100 future value and my rate of return, we took 10% in this example. So 1 plus 10 by 100, T is 1 in our case, right? So 1100 divided by 1.1 will be 1000 present value of this return. Now we have present value of cash inflow, we have present value of cash outflow. Now we can calculate the net present value, that is in our model, net present value, that is PV of cash inflow minus PV of cash outflow, that is 1000 minus 800 and 200 is our net present value. And this is your whole model of net present value in calculating the investment decision. So what do? We take present value of cash inflow, we take present value of cash outflow, and we have to see the net amount that we are getting. If this amount is positive, it means that our investment is profitable. If this amount is negative, it means our investment is not profitable and we will not take that investment decisions. Okay, so this is the basic model, that present value of cash inflow minus present value of cash outflow is your net present value. Now, in order to calculate these present value of cash inflow and present value of cash outflow, you have to be familiar with the few terms that I just mentioned here and some formulas. Okay, so what are these formulas? So number one, I just gave you. You should be able to calculate only one thing, and that is present value and future value, PV and FV. So it is very simple to calculate. How do we calculate a future value? Let's say I have 100 rupees today and I invest it at 10% interest per annum for 1 year. So what I have today, this rupees 100, what is this? This is the present value. Okay. If I want to calculate future value from this, how will I calculate the future value? Very simple. 100 multiplied by 1 plus R raised to T, right? This is how many times, how long I'm going to invest this money, and 1 plus R is my rate of return. So simply we calculate 100 into 1 plus 10 divided by 100. We always take rate of interest like this, right? So that we can calculate it in decimals. And this is your future value. This is the basic formula that you have to learn. If you just remember one formula, that is of present value, sorry, future value, you can calculate anything. From this future value, we can calculate present value also. How? If FV is equal to PV into 1 plus R raised to T, so present value will be, if I take this whole thing here on left hand side, I will get my present value. And these two formulas are going to be the base of your entire calculation in net present value. I hope we are clear till this, right? How we calculate future value and how we calculate present value. R is rate of return and T is our investment time period. We have to take both the things at zero value. Both what? Our cash outflow should also be for 0 period and cash inflow should also be at 0 period, and then we can calculate the net present value. Okay, so let's just read through the notes. NPV involve comparing present value of future cash flow of investment property with the initial cash outlay. It means present value of cash outflow minus present value of cash inflow is your net present value. So we can determine whether the investment opportunity provide a surplus when cash flow are measured in present value terms. As I told you, our basic principle, and that basic principle was whenever we are evaluating the investment, we need to ensure that the cash flows are relating to the same period. That is zero period of time, that is present point of time. Okay. So what are the stages involved in net present value calculation? First of all, we have to estimate all the future net cash flow. We will see all the future net cash flow means inflow minus outflow that is going to happen in future. I will take an example and then it will become crystal clear to you. It is very easy method of calculation of net present value. Okay. Then when I have net cash flow of future, I can convert this to, this is my future value. I can convert this future value into present value by applying discount rate, right? And then add all the present value of future cash flow and subtract it from the initial cost of investment, and then we get our net present value. Okay, so how do we take the investment decision? If the net present value is positive, then it is accepted, otherwise it is rejected. So what we are going to do now, we are going to evaluate one investment opportunity and we will see if this is worth investing or not. Let's take an example here. So you're clear on the formulas, right? So the first formula that we need is of present value. How do we calculate present value? FV divided by 1 plus R power T. Okay, this is your formula that you need for calculation of present value. Now I'm going to give you an example. I want to invest, a company wants to invest in a machinery. Machinery is going to cost 10 lakh today. Okay, and from this machinery, the product we are going to create or the output that we are going to get is of, its life will be of 5 years, and the output will be like this: year 1, 2, 3, 4, 5. The sales I'm going to get from the product created in this machinery will be, let's say, 1 lakh in year 1, 2 lakhs in year 2, 3 lakh in year 3, 4 lakh in year 4, and 5 lakhs in year 5. This is the sale, and the cost each year is going to be let's say 50,000, then 1 lakh, 150, 2 lakh, and 250,000. So this is my future cash flow. Rate of interest that is currently going on market is 10% per annum. Okay, so if I invest anything for today, I will get 10% return on it after a year. Now I have all the terms that I need. And one more thing, after 5 years, when I sell this machinery, because its life is of 5 years, I can only use it for 5 years. I can sell this machinery at salvage value, that is scrap value of machinery, will be rupees 1 lakh. So this is the whole investment scenario that you have, and this is how the questions will come to you in the exam also. So how do we calculate? They are asking us, we need to advise whether companies should invest in this machinery. That is your question. Okay. Now are we clear on the terms of the questions? First step was evaluating the future cash flows. What are the future cash flow? I need to calculate the future cash flows. So I will make a table here. Year 1, 2, 3, 4, 5. I have inflow and I have outflow, and I need net cash flow. So we have this amount, so we will take it exactly like this. 1 lakh of inflow, 2 lakh, 3 lakh, 4 and 5 lakh, and corresponding cost was 50,000, 1 lakh, 1 lakh 50,000, 2 lakh and 250,000. So the net cash flow is 50,000, 1 lakh, 3 lakh minus 150, 150,000, 4 lakh minus 2 lakh, 2 lakh, 5 minus 2.5 is 2 lakh 50,000. So this is my future cash inflow that I will get from this investment. And since this is the return I'm getting in future, this is what? This is my future value. So the next step is to calculate the present value. Calculating present value of return. So I have each year's return now. Future value. Year 1 was 50,000. Year 2 is 1 lakh. Year 3 is 150,000 from here. Year 4 is 2 lakh from this, and year 5 is 2 lakh 50,000. Now, how do we calculate the present value? We take rate of return. Rate of return was 10%. Okay. So there are two methods of calculating our present value. I just gave you the formula, that was FV divided by 1 plus R into T. Right? This is how we calculate the present value. Now, can I say that this is also the same future value multiplied by 1 divided by R power T? One and the same thing, right? And this part I can calculate separately, right? So this part that we calculate, this is called your discounting factor. When we multiply discounting factor with future value, we get present value. Are we clear? So the formula for calculating present value was future value divided by 1 plus R power T. I can also write it as future value multiplied by 1 plus R raised to power T, and this part is called discounting factor. So what I'm going to do now, I'm going to calculate discounting factor for each year at 10% investment, and then I will calculate the present value. So how do we calculate the discounting factor? See, for year 1, 1 plus R raised to power T. 1 divided by 1.01. So 10% is written as 0.1, right? Because it is 10 divided 100. And since we are at year 1, the power will be 1 here. So 1 divided by 1.1. If I calculate this, the value comes out to be 1 divided by 1.1. I will take 4 decimals. 9.91. Okay, this is the discounting factor. Either I can do this, or I can just use this formula and calculate each present value. That will be longer method for you, so that's why you just need to learn how to calculate discounting factors. Next, for year 2, what will be our calculation? One divided by 1.01 raised to power 2. So 1.1 multiply equal to, so on calculator, how do we calculate this power? we take 1.1 plus 0.1, that will be 1.1. Either I can do 1.1 multiply by 1.1, I will get 1.21, or on calculator what we can do, I can simply calculate 1.1 and write multiply equal to. So each time I press equal to, it will keep increasing the power. So one time equal to means the power is 2. Okay, so the value is 1.21. 1 divided by 1.21 is equal to 0.8264. Then for year 3, same method will be followed. 1 divided by 1.01 raised to power 3. So how will I calculate on calculator? I hope you are doing the calculations with me only, then it is going to be useful. 1.1 into equal to, one time equal to means power is 2. Now I need to increase power to 3. I will press equal to one more time. So what result am I getting? 1.1 into equal to 1.331, and the result is 0.7513. Then for year 4, we have same 1.1 into 1 time equal to power 2, 2 time equal to power 3, and 3 time is equal to power 4. Okay, so do this on your calculator. 1.1 into equal to and equal to, so we get 1.4641 for this, and 1 divided by 1.4641 is equal to 0.6830. For last year, how will the calculation go? 1 divided by 1.01 raised to power 5. So till now you know how to calculate raised to power 5, right? 1 divided by 1.1 into equal to power 2, 3, 4 and 5. This is what you need to do on your calculator. Into equal to 1, 2, 3, 4. So I get 1.6105, and the discounting factor is, if I solve this equation, I get 0.6209. So I have calculated the discounting factor for each year. Are we clear so far? What we have done till now? Step 1, calculate the future cash flow. It is very simple. We see the inflow in future and we subtract outflow of that particular year, and we get our net cash flow that we are going to get in future. From that future value, we need to calculate the present value. And how we calculate the present value? We take the future value, multiply it by discounting factor. Formula for calculating discounting factor is 1 divided by 1 plus r raised to power t. That is your discounting factor. I taught you how to calculate discounting factor. Now, next step. We can also write this as PVF, that is your present value factor, the amount that you need to multiply future value with to get your present value. Okay, so the formula is future value multiplied by PVF, and this is how you get your present value. So for year 1, 50,000 multiplied by 0.9091, I am getting 45,455. Do the calculations with me, otherwise there is no point in watching this lecture. 82640. For year 3, what is the value of what is the present value? 1,50,000 multiplied by 0.7513, and we are getting 112695. For year 4, 2 lakh our present value or future value, multiply by PVF of 6.683, I get the present value of 1,36,600. And for year 5 we get 155,225. Okay, so I can erase this part. Now the total of present value. Let's calculate the total. Five three two six one five. This is the cash inflow that I'm going to get from this investment in 0 period. Okay, present value of my return on this investment. Now they have given us first year 1 to 5 we will get this value, and on year 5 we are also going to get another thing, and that is the scrap value from the investment. That will be 1 lakh. So simply add scrap value or salvage value. So the future value is 1 lakh. I will get 1 lakh after 5 years. So it means to calculate its present value, I need to multiply it by 5-year discounting factor. And which one is the 5-year discounting factor? The last one, right? So 0.6209. I get 62090, and the total comes out as 532,615 plus 62090, 594,705. So this value, this total is my present value of cash inflows. I've calculated one part. Now the next part in the calculation of NPV formula is what we have the formula. NPV is equal to PV of cash inflow minus PV of cash outflow. So I have calculated PV of cash inflow as 594,705. And my investment today, how much I need to invest today? I need to invest 10 lakh in this machinery today, right? So minus 10 lakh, and the return I am getting is 594,705 minus 10 lakh, that is minus 405,295. So our net present value on this investment is negative. Therefore, do we invest in this machinery? Answer is no. So I hope you can see clearly by now that when we take the values at present value, when we take the values at same point in time, we can clearly see if the investment is worth making or not. If I'm just focusing on the future value, it may look like I'm getting good returns from the investment, but when we take the if we take the total of these values, so we have I am getting 7,50,000 return in total, but the present value of this investment is only 5,32,000, which is lower than my initial investment. Therefore, it is not advisable to invest in this machinery. So that was your net present value method of calculating the investment decision. I hope you were able to understand. So let me just quickly recap the steps for you. First of all, you need to see what are the future cash inflows you're going to get. Net cash inflow. So how we calculate future cash inflow minus future cash outflow will be your future net cash flow. Then for each of these cash flows, we need to calculate present value, and that present value will be calculated by multiplying this with the respective discount factor that I taught you how to calculate. How we calculate discounting factor? 1 divided by 1 plus r into power t. This is very important, so I hope you keep this in mind. Then future value multiplied by present value factor is your present value. We take the total of present value of cash flow. Then NPV is PV of cash inflow minus PV of cash outflow. If the result is positive, we make the investment. If the result is negative, we don't make the investment. So that is what is given to you in this first method, NPV method. Okay. They have given you an example. In this, the cash inflow at year 0 is 2000. So at year 0, our discounting factor is always 1. Then for each future cash flow, we have taken the discounting factor. Similarly, how we calculated, right? Multiply cash flow with the discounting factor, we get the present value, and we see if the net value is positive, then we make the investment. If net value is negative, we don't make the investment. And if I have to choose between two projects, for example, here project A has NPV of 564 and project B has NPV of 373, my investment will be in project A, which is giving me higher NPV. So that is one way of evaluating your decisions. I hope this is clear to you so far. So we will continue the next part, that is, okay, let's just take the limitations also. The limitations of net present value. So the first one is discounting rate that we just used. So to calculate the discounting rate, we have to take such rate of return that will be constant in the upcoming years, and that rate can be difficult to calculate. Second, different projects are not comparable. So I can use NPV to evaluate one project. If the value is positive, it means I'm going to invest. If it is negative, it means I'm not going to invest. But here I had project A and project B, which were both giving me positive NPV. So how do I choose between these projects? We say the higher NPV we choose, but we forgot one important factor, that here my initial cash flow was 2000 and in project B I only need to invest 1500. So I cannot say that this comparing just net present value of both these projects is the right value of evaluating my investment decision. Therefore, we cannot compare between the projects. We can say, okay, if my only one project I need to see, then NPV is the perfect method. But if we need to compare, then we cannot rely on NPV alone. That is where we use IRR, that I'll teach you further. Then multiple assumptions. So multiple assumptions are like the inflows and outflow will be what we are estimating them now, and there might be a lot of expenditure that will come to surface only when the project actually takes off. So these are some of the limitation of NPV method, to overcome which we have internal rate of return method that we will calculate in the upcoming lecture. So thank you so much for your time for this one. I will see you in other lectures. Bye bye.